What you want to avoid is what Japan did in '89. Japan had the biggest bubble in history, I believe, bigger than the South Sea bubble, and that was...
Jeremy Grantham is a billionaire investor and one of the most closely followed voices in all of Wall Street. He is the co-founder and chief investment strategist of GMO, an investment firm with well over $100 billion in assets. Grantham has never been afraid to speak his mind when it comes to calling a bubble, having successfully called the tech bubble of the early 2000s and a great financial crisis in 2007 and 2008. Now, Grantham is warning that these prior bubbles pale in comparison to what's happening currently in real estate markets across the world. Here's what he had to say.
What you want to avoid is what Japan did in '89. Japan had the biggest bubble in history, I believe, bigger than the South Sea bubble, and that was in land and real estate. And the old story, the land under the Empress Palace was worth more than the whole state of California. We spent 2 days actually asking and digging, and it was. It literally was. First of all, it's a big palace with great palace grounds. And secondly, downtown Tokyo, all around it, was selling for, 4, 5, 6 times downtown Manhattan. And the numbers worked out. Just amazing. Simultaneously, they had the biggest equity bubble of any important market. There are some flaky, tiny markets that don't count. But of any major market, that's the biggest bubble of all time. At the time, we were told it had gone to 65 times earnings. There's always historical revisionism in the data, so you have to be a little careful. But at the time, it was clear, everybody agreed, 65 times earnings, which is pretty remarkable. And it had never sold at over 25 times before. So that's the thing that makes every value manager wake up sweating in the middle of the night, is Japanese stocks. Anyway, they managed to do both of these at the same time. And 31 years later, the land is not back, real estate's not back, and stocks are not back to where they were. This was a loss of perceived wealth so profound that you have to congratulate the Japanese for not going into a depression. And people talk about a lost decade, but that was a lost decade where they actually inched forward. They actually did not go even backwards for the decade. When you're taking that kind of loss of wealth, you're in trouble.
When we think about Japan's bubble in 1989, it's easy to view it as something distant, an isolated event in an entirely different culture and economy. But the reality is, the conditions that led to Japan's economic collapse aren't as foreign as we might think. Here in the US, we've witnessed some of the same patterns play out, and we are not immune to the same risks. Take a look at the US housing market in 2007. It wasn't as extreme as Japan's, but the bubble that burst here triggered the Great Recession, leading to trillions of dollars in lost household wealth. Millions of Americans lost their homes, jobs, and financial security. If we compare that crash to Japan's, the underlying cause was eerily similar: unsustainable asset inflation, driven by excessive speculation and unchecked borrowing. Now let's consider what's happening today. According to the Case-Shiller Index, U.S. home prices have soared nearly 20% year over year, with the ratio of home prices to median incomes mirroring the 2006 peak. Sound familiar? We're witnessing another bubble inflating right before our eyes, not just in housing, but also in the stock market. The S&P 500's price-to-earnings ratio is hovering around 35, far above historical norms. This isn't just theory. Historical data shows us that when valuations climb to such heights, a correction is inevitable. Robert Shiller, a Nobel Prize-winning economist, has documented how every time the U.S. market reaches a P/E ratio of over 30, a major downturn follows within a few years. We're heading into dangerous territory again. But here's the global perspective. When the U.S. sneezes, the world catches a cold. Our markets are so interconnected with Europe, China, and beyond that, a crash here will send shockwaves everywhere. Just look at the ripple effects of the 2008 crisis. Global markets tanked, and it took years for most economies to recover. If we don't start preparing now, understanding the patterns of history, and addressing the vulnerabilities in our financial systems, we risk repeating the same mistakes. We're not just talking about economic downturns. We're talking about wiping out generational wealth, stalling innovation, and leaving millions vulnerable to financial ruin. The warning signs are all there. The question is, are we paying attention?
Now, in the so-called great financial crash, which irritates me as a title because I think it was a housing bust, the housing market had this perfect 3 sigma, 1 in 100-year outlier bubble. had been very, very stable historically. So to get to that level, it only had to go up only, he says, about 40% or so in 2 to 3 years, which it did. And then it gave it all back. But the trouble with 2007 housing bubble is it took the stock market with it. The stock market was not sensationally overpriced, but it was a big overpriced bull market. It was not in itself a bubble. The housing market was a bubble, a beautiful, magnificent bubble. And if you look at it, it's perfectly round. It goes up for 3 years. It goes down for 3 years, exactly the same speed. And it goes all the way back where it came from. And the housing bubble inflicted about $10 trillion of loss of perceived value. So 1 minute you thought your house was worth $400,000. 3 years later, you were told it was worth $550,000. 3 years later, you were told it was $400,000. And 2 years after that, $350,000. So you had lost an enormous asset. And housing markets are much more dangerous because more people own them. The middle class, in particular, that owns very little stock, owns a lot of housing. And it really, when you lose that value, you skip the trip to Portugal and you realize you can't send your second son to private school. And it really flows through the system. Don't do it.
The 2007 housing bubble is often referred to as the Great Financial Crash. But Grantham is right to be irritated by this title. It wasn't just a financial market issue. It was deeply rooted in housing, a sector that directly impacts everyday Americans. Think about it. Housing isn't just an investment. It's where people live, raise families, and build their lives. When the housing market collapses, it's not just numbers on a stock chart. It's the loss of homes, dreams, and financial security. The effect on middle-class Americans was devastating. Unlike the wealthy, who could weather the storm with diversified portfolios, the average household is much more dependent on the value of their home. According to the Federal Reserve, homeownership represents nearly 60% of total wealth for middle-income families. So, when property values collapsed, it wasn't just an investment loss. It meant fewer vacations, canceled education plans, and tightened budgets. If you're looking for an example, consider this chart of U.S. home prices from 2000 to 2010. The rise is sharp, but the fall is equally steep. The recovery? Slow and painful, especially for those in the middle income bracket. The fallout from the housing bubble didn't just affect homeowners. It rippled throughout the economy, leading to job losses, reduced consumer spending, and an entire generation struggling to recover financially. The danger with bubbles like this is that they erode the financial foundations of ordinary people, not just Wall Street. This is why understanding these cycles is crucial, not just for economists or investors, but for everyone with a stake in the housing market, essentially, all of us.
So what do we have this time? We have, of the 4 major asset classes on the planet, we have 3.5 in bubble land. We have, Jim Grant would say, the most overpriced bond market and the lowest rates in the history of man that go back 4,000 years. There was never a time when so much had a negative return where you pay the government to take your money. So that's number one. Number two, we're a contender for the highest priced U.S. equity market history. I would say a majority of bubble experts think this is now slightly higher than 2000, which was epic, and some people do not, but at least we can all agree it's a contender. And then we have real estate, and real estate was kind of off screen until a few minutes ago. And suddenly, on some of the databases, it has risen 20% in the last 12 months. As Shiller's series, a little more conservative, lags quite a bit. I think it's only up 13, but the other series, perfectly seriously done. Up 20 is the sharpest rise, sharper than the 70s with inflation and sharper than the housing bubble of 2005. And what that means is metric we hero worship is multiple of family income. How much does the median house, the one in the middle, how many multiples of the median family income is? It's a nice, stable, fair metric. It used to be in America that we'd sell at 3 times family income. And in the bubble, we kind of went to 4.5 or so and then back. And we are now at the multiple of family income that we were in '06, the very peak of the housing bubble. We're back. Now, the rates are very low, so all being well, you can, quote, afford it. What you can't afford to do, if you're a beginner, is buy it in the first place.
What Grantham is highlighting here is a critical warning. We're not just looking at a single bubble, housing, equities, or bonds, but multiple bubbles simultaneously. It's a perfect storm brewing across several asset classes. And history tells us that these bubbles don't pop gently. Let's break it down. When we talk about bond markets being at their most overpriced in 4,000 years, we're talking about a financial landscape that's entirely out of balance. People are paying governments to hold their money. That's right, paying for the privilege of losing purchasing power over time. When interest rates are this low, it inflates asset prices across the board. And that's exactly what we're seeing in the US equity market. By many measures, it's now even more expensive than the infamous dot-com bubble in 2000. Remember how that ended? Now, look at the real estate market. House prices have shot up 20% in just 12 months, a pace we haven't seen since the 1970s. For perspective, the Case-Shiller Home Price Index, which tracks home prices, shows a 13% rise, and that's considered conservative. What's even more alarming is that housing affordability, measured by how many times the median income it takes to afford a median-priced home, is now back to the peak levels we saw in 2006, just before the housing crash. Here's the problem. While low interest rates make mortgages more affordable on paper, the reality is far different for first-time buyers. They're priced out of the market before they even get started. Think of it this way. If you're a new home buyer, how do you afford a house when it costs nearly 5 times your family income? It's an unsustainable setup. And we've seen where this leads. The lesson here is stark. Bubbles don't last. Whether it's bonds, stocks, or real estate, when these markets become detached from the fundamentals, like how much people earn or the real value of goods and services, we're setting ourselves up for a fall. The scary part is that when multiple markets are in bubble territory simultaneously, the ripple effects of a collapse could be even more severe. We need to approach this moment with caution, recognizing that historical patterns have shown us time and again that what goes up in an unsustainable way must inevitably come down. The real question is, are we prepared for that impact? So there you have it. Make sure to hit that subscribe button because it is my goal to make you a better investor by studying the world's greatest investors. Talk to you again soon.